Welcome to another week of The Educated Homebuyer Live, where Josh and myself answer your mortgage and real estate related questions while updating you on what's happening in the economy to help you become the educated homebuyer. So, Josh, we've actually been on 2 additional times since our last time last week. We did a Friday episode, we did a Tuesday episode. So, we're going to recap what happened yesterday and what happened today. And then we'll start looking at some charts. So yesterday we had PPI come in, and there was a revision from last month, which actually helped the market. We saw the 10-year, kind of pull back in a meaningful way, which is a really good setup for today. Today we had CPI. CPI fortunately came in a little bit better by 0.1, coming in at 0.3. And I think the real winner today was retail sales coming in basically flat. And then when you start looking at the numbers deeper, you said, Josh, what, a negative 1.7? Was that right?
It's not that bad. I've got it in the charts. I think it's negative 0.66 when you actually account for inflation. So although retail sales increased, it was all due to inflation. When you take away the impact of the last 12 months of inflation, sales were actually down from a year ago.
Good stuff. So, Mr. Josh, how are you this evening?
I'd be doing better. I'd be doing better if my straw hadn't fallen into my drink here.
Well, you have some time now to pull that straw out while we dive into some charts. So while we're looking at charts, guys, do us a favor. If you have questions, comments, something you want us to read out loud, do us a favor and put it in there. And at the same time, if you're new here, this is your time to ask questions. We appreciate everybody continuing to show up every week and do that. It's what makes the show go on. And if you haven't done so, hit the thumbs up, subscribe to the channel, and we'll talk a little bit about the podcast that we filmed this week after we look at charts. So, Josh, we always like to start by looking at inventory. So this week, we're sitting at 568,000 single-family homes on the market, up 1.5% from last week, and that's 35% more inventory than a year ago. With that, Orange County sitting at 2,507 listings. This is the highest number we've seen. It was more than any time we saw last year, or did we hit 2,600? I don't remember, but we'll look at the numbers here in just a minute. And Huntington Beach sitting at 151. Now we've thrown in some charts, Josh, because we've been tracking this information for the better part of a year now. And you can see we're sitting more or less the highest number of listings that we've seen in Orange County going back to 2022. So inventory is rising, but still considerably less than that 2019 level. And it's because rates are staying higher, inventory is building, and it'll be interesting to see what happens, Josh, over the next couple of weeks as we've seen interest rates actually pull back a little bit.
Jim, and then Huntington Beach.
Yeah, go ahead.
I have to confess, having our own proprietary charts that we created, it makes me feel better. Being a data nerd and having our own created charts, it makes me feel better.
Yeah, they're not pretty per se, and I've thrown them into ChatGPT to make them pretty, and they just came out funky. So if you're a graph person, and you can do make graphs pretty, comment and let us know. We would like a pretty graph. And so we'd be willing to
we'll trade an educated homebuyer t-shirt for prettying up our graphs.
Yeah, exactly. So these
and a hat.
And a hat. There you go. I like it. But these are what the charts look like. You can see inventory is rising, but nothing crazy at the moment. We will keep an eye on it. Weekly inventory change, it went from 559 to 568. So considerably better than what we saw last week, which was, I think, about a 3,000 increase nationwide. Now we're seeing close to something almost 9,000 week over week. You can see the same week last year went from 420 to 421. So kind of a much less meaningful move last year, and inventory was a lot lower. And now we've seen, we haven't quite seen it yet. Inventory peak last year for 2023 was at 569,998. We're about 1,500 homes shy of that at the moment, which means next week probably going to have the highest level of inventory that we've had going back to 2022. Active inventory. This comes from Calculated Risk. Like to show these as they become available, but this is looking at inventory through April. And what I like to point out is, the year over year numbers where you're seeing inventory increase, but then look at the 2019 numbers as well, because it really gives a little bit more context. But year over year, most of these markets are seeing an increase in active inventory. Connecticut being one that is still negative, and we've talked about the Northeast there being a problem with regards to inventory. But year over year, when you look at 2019, all of these markets are more or less still down pretty considerably. On average, 22.3% in all of these markets. But the one outlier there is Jacksonville. Jacksonville inventory is up 70% year over year, and versus 2019 up 20.6%. We're actually going to look at Florida here in just a little bit in another chart that has a little bit more meaning to it. But new listings, Josh, 69,000 new listings unsold this week. That's 3% fewer than last week. But we also had another 21,000 new listings that are already in contract. So, pay attention to this stuff. Inventory is up, but again, it's that time of the year where you start to see a little stall because of where we are. New listings, again, year over year versus 2019. Throw this up. You can kind of go through it when you're looking at it year over year. Pretty much every single market is up with new listings, but when you compare it to 2019, you're still down. Jacksonville still being that outlier there here, but still down about 16.7% on average versus 2019. Then we take a look at total home sale contracts pending. Median price of homes in contract is now sitting at $400,000. That's up 4% from a year ago. The median price of all homes on the market at the moment is sitting at $450,000, which is more or less unchanged. That takes us into the median price of home. Actually, I did those charts backwards. This is the chart that I just mentioned. And then this chart, total home sales pending, 393,000 single family homes in contract now, which is a couple percent more than the same week a year ago. New contract pending this week is just over 73,000. That's down 7% for the week and still 6% more than the same week last year. And then the last one, which is the title of our video, Josh, with percent of properties with price reductions now sitting at 33.7%. So more price cuts this week, up 30 basis points from last week, 410 basis points more than last year at this time. And there are more listings with price cuts right now than in May in the past decade. So you're looking May over the last 10 years, more price cuts this May than over the last 10. So somewhat, meaningful, especially if you're in one of these markets that has a lot of inventory, you're probably starting to see more price cuts. So let's look at this one, Josh. Shift in home prices.
I think they're all in Southwest Florida.
Yep. But let's talk about this, because this is what people are telling us, and this data more or less confirms it.
Yeah, one thing that was super interesting before we go to the obvious part that everyone's talking about in Southwest Florida, showing the strongest market is San Jose, California. One of the big markets, if we looked at it, had the biggest drawdown from early 22 peak was the Bay Area, and we're seeing the Bay Area is performing well, top 3 to 5 market. Seeing something similar in Seattle. If you look at how blue it is up there in Seattle, the markets that had heavy exposure to tech jobs and it got beaten up are recovering. So maybe tech is doing better, and those folks are not as worried about getting laid off as they may have been when Amazon and Google started doing their layoffs. But got a lot of issues in Southwest Florida. There's still, Jeb, I don't know enough about this to speak on it. Maybe you've seen some more articles. Apparently still a lot of hurricane damaged properties down there that people haven't rebuilt or insurance companies haven't settled on. You've got the condo issue. You've got the overall insurance issue, which we did that episode on a few weeks back. But if you look, most of the country is solidly positive between March and April in terms of prices, except for those Gulf Coast states that we've talked about.
No, and again, it just confirms what you guys are telling us. So this is a look at CPI. So again, we talked about CPI earlier. What are we looking at on this chart?
So this is the year over year. Headline was at 3.5%. I got them backwards here. Thank you for my brilliance there. 3.4%, 3.5 previous, 3.6, 3.8 previous. So we had got off to a relatively hot start earlier in the year, and we can see it in got my charts out of order here. We can see it in this data, because if you look and go January, February, March, we were coming off of October, November, December. We had 0.5 total increase over those 3 months. We went 0.3, 0.4, 0.4. So 1.1, which would equate to an annualized rate of 4.4% in the first quarter. And people were afraid that we were going to see another 0.4 today. So those red boxes there, Jeb, what I wanted to show is 0.3 came on and 0.4 fell off. So that's why we saw the improvement in the year over year. Next month is where it gets dangerous, because we've had big numbers falling off, getting replaced by big numbers. Right now, we have a 0.1 that's going to fall off next month, and that will tell us what next month looks like. So I threw this in here. It's one of the regional Federal Reserve banks does an inflation nowcast. So what they are projecting is for next month 0.11. So that's we're through 15 days of the month. So halfway through the month worth of data, they're projecting 0.11. So if we see that and it falls, the 0.1 falls off, we won't really see any month over or year over year improvement, but that month over month improvement from 0.3 to 0.1 will again tell the Fed that we're moving in the right direction, more slowly than anticipated, more slowly than they wanted. But what I wanted to show in here, Jeb, there's only two things that are accounting for like 80-90% of this increase in CPI. Everything else is on track or below the Fed's preferred 2%. Shelter, we've talked about a ton here. If you look at apartment lists, and I meant to pull out, our guy at Calculated Risk has a much better chart that shows not just apartment lists, but 4 or 5 different measurements of what shelter costs are actually doing year over year. But in CPI is picking up 5.5%, and it's moderating. It's down from 8.2% a year ago, but moderating very slowly. Actual apartment rents per apartment list have gone from 18.2% in the middle of beginning of 2022 down to negative 1.3, negative 0.8. So we're seeing disinflation there. It's not getting picked up yet in the numbers that are used in CPI. And the important part, Jeb, here to know, we may be nearing the blue line, the apartment list stuff, that may be nearing a blue line, because we have more apartment supply coming online this year than we've seen in a long time. So additional supply, kind of market may be bottoming there. It'll be interesting to see if those two lines kind of converge, hopefully below 5.5. The other one, car insurance. It's not a huge component of CPI, but it has had a huge jump. And both of these things are kind of important to note. The Fed doesn't really do anything that controls housing rents, shelter rents. They can control rates to a degree that will impact what home buyers pay, but not people that are going out and renting their shelter. There's not really anything they can do to control the cost of inflation. So it kind of goes back to why we focus more on the core, which is things that the Fed feels they can control versus the headline number. So again, that will be interesting month over month. This one, Jeb, we looked at it earlier today. This showed up in one of the newsletters I subscribed to. The dotted green lines there are the dot plots from the Fed projections. They quarterly at the last meeting of each quarter, they put out their projections. They poll every voting Fed member and they say, what do you see a month from now, a year from now, and put all that info in there. And if you look, they're not wrong directionally. They're just generally early. So rates go up or down further down the line than they think. So we're kind of seeing that right now, that they were probably early in the fourth quarter expecting we were going to see some improvement, but they probably weren't wrong. It's just a matter of being early. So we'll watch. It'll be something interesting to watch. One of the things, Jeb, that people talk about that has been a cause of inflation is right at the beginning of the pandemic, Fed floods the market with money. So M2 goes through the roof. We saw it drop. And then as we've seen inflation pick up here over the last 3-4 months, money supply has actually increased a little bit. The green line is just the linear trend of what would have happened had there been no pandemic and the government hadn't changed what they were doing. So hopefully when we flash forward, we talk about home prices don't have to crash for affordability to come back in line. It just takes time where wages are increasing, interest rates come down, and that green line can meet. So hopefully the same thing here. the Fed can pull some money supply out of the market, that linear trend comes up, and we get back to something more resembling normal and see that 2% inflation that we had for so long. The other thing, Jeb, you had talked about today, retail sales. So the year over year change, the blue is not inflation adjusted. So the year over year was up 2.67%. You go, well, that's pretty strong. But for the last 12 months, it's averaged 4.65%. So a full 2% below what the 12-month average has been. But when you take here and adjust for inflation, it was actually down 0.66%. So meaning retail sales were down 0.66% over the last 12 months in terms of what was actually sold. The prices of those things went up. So retail sales were better on a dollar amount basis, but not in real terms. So what we're seeing, Jeb, we'll see this in the 10-year when we look at that chart here in a moment, but the probabilities are kind of moving back towards earlier point in the year. We're now seeing a 91% probability of that first cut per the futures market. So remember, these are real wagers, real bets, real money, but it's a moving target. It changes every day. So after today's CPI and retail sales, 91.84% chance that we get a cut at that September meeting. And if not, a very high probability that we would get it in November. And we're also seeing 99.34% that we're down 0.5% by the end of the year. So that will be interesting to watch and see which direction it goes. Now, Jeb, you and I have been watching this lovely chart here for weeks, and we finally got what we wanted to see. As we talked about, for those of you who are here regularly, those two red lines are an up channel, up in yields, bad for interest rates. This is the 10-year, not mortgage rates, but mortgage rates follow the 10-year. And when we look at this, we said, this is great that we went from the top of the channel to the bottom. But until we break out of the bottom of that channel, it is not a trend change. It is just a correction within that up channel. So we broke out as of today in a big way. This on the daily chart, we broke through this 50% Fibonacci retracement. That just means from those highs of those candles on the left to the lows of the candles on the bottom, we've got half of that back. So it's an important level because usually the market will pause there, and it just blew through it today. We went down to this bluish line. That's a pivot that goes back. What does it go back, Jeb? 8-9 months. It's been an important point, and we're sitting right on it. So we don't have a lot of data coming up over the next couple of weeks. Tomorrow, we do have weekly jobless claims, which were up last week. If we see another spike in them and it pushes us through that, very good chance that we run down to this yellow line where we have, I think that's the 200-day average and another Fibonacci level. So it'd be interesting to watch that. What does that mean in terms of interest rates? 6.99% is what Mortgage News Daily is quoting on the 30-year as of today. FHA is about 6.5. That's pretty accurate. Well-qualified borrowers do a little better. People with slightly lower or worse credit scores are going to pay a little bit more than that.
All right. Good stuff, Josh. So take us out of the charts there. With that said, guys, if you're looking to get a quote, you're looking to get pre-approved, you're looking to compare quotes, you want to work with Josh, you want to work with our team here, I'll actually put a referral link to scroll to the bottom there where you can actually reach out to us and have a conversation. If you're looking to buy, sell a home here in Orange County, I can be of assistance to you. Would love that opportunity. And if I can't personally do business for you because you're outside of my area, I will refer you to somebody that does business like I do that will take good care of you. So that referral link will get you to us, and we can get you moving in the right direction. So Josh, I mentioned earlier, we're going to mention the podcast. So the Educated Homebuyer podcast, YouTube channel. We did a video, posted it yesterday with Ed Pinto from the American Enterprise Institute, the housing center. He is a very intelligent man. Kind of takes you back on the history of real estate, why we're in the situation we are in now with regards to supply, how you can fix the problem, just a lot of really granular type of information that if you're just an information nerd, it's really good stuff. I promise you, it's stuff you haven't heard us ever talk about before. 90% of it. And he does it in a way that is very easy to understand. So go check it out. A lot of positive feedback.
Jeb, instead of just you and I telling them how great it is, because it was a very good episode.
Yeah, read the comments.
And Jeb and I don't talk very much, but read the comments on the video. Marcus Doswell says, the video you dropped yesterday on the Educated Homebuyer podcast was outstanding. Learned so much, especially seeing how the lack of inventory issue goes all the way back to 1922. Ed has a ton of historical data in there. The interesting thing is it has literally 1/3 of the views of the episode from a week prior. But if you read the comments are outstanding, like probably the best comments we've ever got on an episode. So thumbnail and title are a little bit tough to draw people in for that, but everyone that takes the time and watches it raves about how good the content was. And again, it's not Jeb and I. Ed really knows his stuff.
Yeah, Love for Puppies also made a comment. Really love that interview. So appreciate you guys. Appreciate the support. That's what helps. You can continue to support the show by hitting a thumbs up, by subscribing to the channel, regardless of where you're watching. And if you're watching on one channel, go do it on the other. It does help. And again, pushes us to do more content like that. And if you have somebody you want us to talk to, let us know. And don't put some idiot. Don't put some crasher in the comments that you want us to talk. We're not talking to these people. We're talking to people that are intelligent, people that are using data to make decisions, people that actually provide value. That's who we want to talk to, because we want to bring you guys value. So if you have somebody that you recommend, let us know. And if you have a connection, that's even better. Warren Buffett would be a really good one. We'd love to have Warren on the show.
That would be excellent.
Or Dave Ramsey. You know, we'd like to
don't suggest Charlie Munger. That would be inappropriate.
That's mean, Josh. Okay, so we're going to start with some comments here, and we're going to go through them. One of the first comments comes from one of our regulars. Love for Puppy says, with the new buyer agency agreements, do buyers have to let lenders know how much commission they agree to pay their agent to factor that into the pre-approval? Good question. My guess is I don't believe they do, at least not yet, but it's not a bad thing. Here's the thing is, the buyers don't know how much they'll be paying, right? Because you don't know how much the seller's willing to pay at this point. That's still to be determined, still to be negotiated. You could agree to a certain percentage with your agent, but that percentage could change. You could not have to pay anything. You might have to pay a portion of it, so on and so forth. So a lot changing there. But Josh, what are your thoughts on that? Because do you need to know if they've agreed to pay?
Well, I think it would be included in the cash to close conversation. We would have to know where the money is coming from. Speaking of that, that was the episode we recorded today, probably about 10 days out from publishing that one. But in the context of that conversation, if money is coming into closing, the lender wants to know where it's coming from. And the primary concern for that is that they're worried there's a loan out there, that you borrowed the money from somewhere. There's repayment on that, and they haven't considered it in your debt to income ratio. So if we get to a situation where buyers are regularly paying their agents, I believe it will be things. So it's not that it can be hidden. It will show on your settlement statement. Underwriter's going to review the estimated settlement statement. They're going to review it right at closing. Any funds that you are bringing into escrow will always need to be sourced and seasoned from an acceptable source. So if that becomes more common of buyers paying for their own agent representation, then it will be something that will fall under those same guidelines.
Good stuff. Jill has a question, says, I want to sell my home this year, but I'm worried insurance is going to be an issue. We live in a high fire area where a lot of my neighbors are getting canceled. Do you see that stopping buyers? It could. I haven't seen it yet, but it is creating issues. Insurance is becoming an issue, more and more common here in California. Just because of everything going on. You have way less insurers out there. I don't know that you're in California, but you mentioned high fire area, so it leads me to believe that you probably are in California. The one nice thing about California, good or bad, is that there is California Fair Plan, so there is insurance always available. Not that you might agree with the price on it to pay it, but there will always be an option for it until they run out of money, which, you know, that could happen at some point in the future too, I guess. But it's something, I mean, if you're going to sell your home, don't let that be the thing to stop you from selling it. There's always options to figure out the insurance, right? And by waiting, it's not necessarily going to get any better. But what I will say is I had a conversation yesterday with a buddy of mine who is an insurance agent. He does home auto. And right now he just does life insurance because all of the carriers that he did business with no longer do home and auto here in the state of California because of everything that happened. And I said, what do you see happening? Is that going to change? And he said, by June, there should be a resolution here in the state of California. He believes that there's going to be a resolution based on the information he's getting, which means some of these carriers that left the state could be coming back within the next couple of months because California is going to change their tune on how insurance is done based on my understanding, which could allow more carriers. So you could get ahead of it. But it just really depends on time. I wouldn't time my house based on what's happening in insurance. I would time my house based on what I'm trying to accomplish, and the insurance falls in where it will. So, all right, Mr. Lewis Mitchell says, I used to sell car insurance and work at a big player. The car insurance costs are stupid. Increases for it are BS and honestly terrible for how it is. Kind of why I needed to stop and find another job. So this just kind of goes along the whole insurance idea. Car insurance is an issue. California, if you're in California, it is a bigger issue because of how they have limited insurers from raising premiums for such a long time, that now that they've been able to do it, these guys are just raising the max that they can to be able to play catch up. And that's creating issues versus allowing gradual increases over time. It's, hey, no, you can't do anything. And then 5 years later, okay, we'll allow this up to this. And everybody goes, okay, well, we're going up to the max. So just understand car insurance, house insurance, it's more and more of a problem at the moment. This one's another insurance. Josh, are you just putting insurance stuff in here? You just loaded it up with insurance?
Yeah, exactly.
So just again, another viewer saying my homeowner's insurance just went up $1,500. They live in Minnesota, changing to a new carrier. They won't let me renew in 8 years when my roof is 10 years old. Ouch. So another thing you can do, we had somebody talk about it yesterday. You can raise your premiums, guys. There's things you can do to avoid the big increases. They're still going to increase, but there's ways to mitigate how much you're paying per month. But you have to understand the risk of doing that. So just, again, get a couple of quotes, understand the difference in premiums, and then make the best decision you can with that info. All right. Kate is asking, is there a limit on how much a deductible has to be when getting an FHA loan? Josh, so what are we talking about here with the deductible?
So your deductible is if you have a claim, it's the amount that you have to pay out of pocket before the insurance company comes in. So FHA, if your deductible is $50,000, obviously they may have a reasonable concern that you can't come up with that if you were to, say, have your house burned down so it can't be rebuilt. FHA, my understanding, and I would have to look this up, so don't quote me 100% on it, but my understanding is that your maximum deductible is 100% of the dwelling coverage. So if you're buying an $800,000 house here in Southern California, that doesn't mean $8,000 because the dwelling coverage is probably $350,000 or $400,000 to replace that. So it could be sub $5,000. So if you're in other parts of the country, it could be fairly low. But let me research that, and I'll try and come back next week and have 100% answer for you. But that is my understanding from a little bit of research.
All right. No says, I recently put an offer on a house. The seller received 3 offers that were $25,000 over the asking price. Any advice on how to compete in this market? So yes, I've done multiple videos on this. I would say go to my channel and look at videos, under the playlist of buying a home. I talk about how to compete in this market, even how to compete against cash offers, ways to stand out. Instead of doing that and going into detail here, just check out the video. It's, I've done it more than 2 or 3 times in talking about how to stand out. But there's multiple things you can do to compete. But at the end of the day, what I will tell you, the most important thing more often than not to a seller is the price. So regardless of how competitive you are and all the other things that I talk about, if you're not competitive on price, you're not going to be competitive. Now, on the other side, if there's 3 offers and you're all pretty similar in price and you do the other things that I talk about, chances are you got a really good chance of winning. So just know that price is first, and then everything else is secondary. And I know that sucks, but it's the reality. You got to know how to do it.
Well, Jim, I told you I had an interesting one today. Let's say in that instance, those 3 offers come in, they all look kind of similar, and one of the 3 or 2 of the 3 loan officers reach out and follow up on that offer and ask Jeb, the listing agent, hey, Jeb, any questions that you have, that your seller have, anything that we could possibly do on our end to sweeten the deal? I've worked with these buyers 4 times in the past. They're amazing, 800 credit scores. I have every last thing. We can close in 17 days. What's important to your buyer? So again, if 2 of those loan officers do it and the 3rd one doesn't, and the offers are relatively the same, I can say it's probably going to go that direction. So, and I'm not the only one that does this, but there are fewer that do it than there are that don't do it. I had an agent today, it kind of blew my mind that he was like, dumbfounded that I wanted him to copy me on the offer when it went. And he did not do that. And I'm worried that we're going to find out tomorrow. It's a property in San Diego. San Diego is a hot market, that we're going to find out that we missed out on another property because he's just winging out offers. So it's not something that takes you from a 10% chance to a 90% chance, but it definitely stacks the odds in your favor.
Yeah, you've got to do as much of the stacking as possible to really put the odds in your favor. And that doesn't mean you need to do crazy things like waive all your contingencies or, some crazy escalation clause. It just means little things added up together make big things. And what I mean by that is if you can stack everything in the seller's favor, so to speak, while still keeping your line in the sand that you're willing to negotiate up to, and without putting your deposit at risk, you can win on these properties. So, but enough about that. If you have questions, go check out the videos that I've done. They have the information that you're looking for. All right, Josh, I guess we're done here. No other questions. Great seeing you guys tonight. No, listen, if you have questions,
we've been answering questions 2 days already this week. They've run out. We've answered them all.
So guys, you guys asked us last week for another hour. We couldn't give you another hour. So what we did is we gave you 45 minutes on Friday at a random time. And yesterday we gave you 35-ish minutes or so at a random hour. The random part sucks, I know, because you guys can't plan for it. If you hit the bell notification when you subscribe, I think it will alert you when we go live. But the reason we can't commit to a specific time is because, this time is in the calendar. The other times are, hey, Josh, do you have 30 minutes? Do you have 40 minutes so we can go on and have the conversation? It just it changes. It's going to change. But I would love to know. Let us know in the comments right now. Do you enjoy that? I mean, did you like the extra days? Is it, have you been able to see us online? Is it worth us doing it? Let us know. And at the same time, if you haven't hit the like button and subscribe to the channel, that would be appreciated. In fact, Big G is telling people to smash that like button. And told us there's we used to have 300 people on my channel alone watching this. Now we only have 70 something and 20 something on the other channel. So we're either getting worse at doing this, Josh, or there's just less people out there in the market that are interested in becoming educated. So that means you guys that are getting educated are leaps and bounds above all the other people that are doing nothing to step up their game.
Interestingly, I'm assuming that the 29 people that are watching on the Educated Homebuyer channel are all subscribed, but we are 23 subs shy of 4,000. So if the 67 on Jeb's channel, if all of you run over and subscribe to the Educated Homebuyer podcast, it will push us over 4,000 and will give us a big ego boost. We can go home and tell our wives, well, Jeb already has 100,000, so he wouldn't tell her anything. I would say I have a 4,000 subscriber YouTube channel.
There you go. And it's all, Josh needs to impress his wife. His wife's not impressed with him.
She's not easily impressed.
She's not impressed with him at all. And he wants to still impress her. It's been a long time since he's impressed her. So guys, help Josh impress his wife. Let's see here. I just saw a good question. Here we go. Jeb, when you refinance prior to your first payment, do you do that with the same lender? I would recommend doing it with the same lender for a number of reasons. One, in the instance that I bought my house, the lender actually reached out to me and said, Jeb, we can actually lower your payment and whatever. And so I was able to lower my payment without even making the first payment. It was crazy that I was able to do that. But typically what happens is your lender, when you don't pay points to a lender, your lender gets paid on the yield spread of the rate that they give you, right? So the lender's actually paying them by doing the loan with their company, if that makes sense. What happens is when you refinance and you don't use the same company, that lender has to repay back that premium that they got paid. You're basically screwing that person that did your loan. So if you like the person that did your loan, don't screw them. Give them an opportunity to at least compete for the rate and try to win it. Now, if they can't do it, they tell you we're not doing it, then if you can find somebody, sure, go for it. But at least give them an opportunity. And that's the main reason that I would go back to the same lender. And again, use people that you've had a good relationship with, that you've had a good experience with. I can't tell you how many people have told me in the past, my lender sucked. I would never go back to them, whatever. And then they end up using the same lender again because it's just easy. Don't have a short memory when it comes to this stuff, guys. use the people that you trust, the people that communicate well, and, you know, give them an opportunity. And if you need another opportunity, you can reach out to Josh and myself using that referral link in the description of this video. We truly want to help. So Josh, Jeff is asking, my mortgage company has changed 3 times within the last year. Is that normal?
It's not normal. That's excessive. So generally, say 70 to 90% of the time, your loan is going to be sold right after closing. So if you close a loan with us, it's going to close in the name of United American Mortgage. And by the time you make your first payment, it's going to go to the end investor that we place your loan with. Most of those investors service loans themselves, and so they're going to keep it. Some of them don't, and they end up selling the loan off to someone else. So a couple times in the first year wouldn't be way outside of the realm. 3 times is unique in 1 year and generally happens when lenders and servicers are having liquidity issues, or servicing rights are getting expensive or cheap, and they just want to unload or acquire servicing rights. So I wouldn't count on it happening or worry about it happening again. It is a rare or infrequent occurrence, but the most important thing to remember is there's nothing you can do about it. It's what's going to happen is going to happen. So just roll with the punches, set up the auto pay at the new place, and hopefully it doesn't happen to you again too soon.
Good, good. Jonathan is asking, thoughts on locking my rate today. My lender wants to wait 1 to 2 weeks before we lock. So Josh, what are your thoughts on that?
My first thought is, who gives a shit what your lender thinks? I am here to advise you and give you all the information. If you say, hey, what would you do? Or what are your thoughts? You guys know I show up here. I will share my thoughts. I will tell you. But
Josh is not short of sharing his thoughts.
But I don't make that decision for you. And if you tell me, hey, I want to lock, it's not appropriate for me to say, I'd like to wait a week or two. I can tell you, hey, we're 40 days from closing. If we wait 10 days, now we're going to have a 30-day lock. I can pull out the chart that we lead off the show with here and tell you why. If I'm a borrower right now, I want to see if we can get through that pivot level that we have below us. I want to see if we can get down to that next Fibonacci level. Because if we break there, you're probably another quarter. So we have at least an 1/8 of improvement potential out there. And if we get to there and go through that, we have a quarter below that. 0.3% on a $400,000, $500,000, $600,000, $700,000, $800,000 loan is real money. At the same time, I want to have the conversation with my borrower and say, tell me what your risk tolerance level is. And I will even go so far as, after you tell me that, okay, so if we float, which 2 of my borrowers yesterday said, I'm cool, let's float through CPI. I said, okay, so if I call you tomorrow morning and rates are an 1/8 or heaven forbid 0.25% worse, you're not going to be happy, but you're not going to kick yourself. You're not going to be mad at me. You're going to be okay with that. And both of them said, yeah, I'm not going to be happy, but I will be okay with that. And let's take a shot. And both of them ended up an 1/8 to 1/4 better today versus the worst case. We quantified it. What is your risk? What could you possibly give up? Is it 50-50? Is it a coin toss? Which way do we think it's going to go? And really, you know, I had a gut feeling that we were going to have good numbers today, but I also, as a betting man, wouldn't have said much more than 50-50, 55-45, 60-40. Just had a feeling that we had had some crazy data in the first quarter that was unnecessarily strong, and we were due for something to reflect a little bit less, where we were priced for doom, not priced for perfection. We were priced for the opposite of that when we were pushing up at 475. So, Jeb, I love that. I love my ability to throw my left hand out and turn.
So what's the definition of insanity, Josh? Just give me the one sentence. What is it?
Doing the same thing over and over again and expecting a different result, such as throwing your left hand out while you're talking and making
Josh
the damn light come on.
You notice comes on every episode, and Josh hates it because he has a sensor in his office that sets it off after a certain period of time. Here's the deal. I've given Josh the solution multiple times. I said, Josh, because it used to happen in my office and I hated it just like Josh did. And so I went in, took the light plate switch cover off, changed the setting on the sensor, just took it off entirely. So now I have to manually hit it when I walk out of the office. It's tough. It's tough sometimes to do it, but I do it. And I don't have that problem. But Josh refuses to let me. But bitches about the problem. Just saying, Josh. You know, Angela, I know you're listening to this.
I want to remain compliant with the laws of the great state of California that want to make sure we're not wasting electricity.
Yeah, that's it. No has another question here. Says, does your real estate agent need to show up to an open house? No, they don't need to show up to an open house. Some cases you might want your agent there to an open house. Typically, what I tell clients is, if you know you're going to go house shopping and you're going to go to a bunch of properties and go to open houses randomly, whatever, just go to them. If you have questions about a property, you like a property and you want to make an offer on a property, that's when I'm like, hey, I want to see the property that you're making an offer on. In most cases, sometimes we write an offer without me seeing it, but your agent doesn't have to be there. But if you are going to open houses, talk to your agent about it, and they can guide you through that process. But you can do it by yourself. You can do it with them. Doesn't matter. Josh,
we had an interesting follow-up to that last question. Legacy Op says, rates have been dropping slightly. Your lender knows this. He's trying to help you out.
Well, what happened? Here's what I would say. Anybody that's telling you we have to wait 1 to 2 weeks, in my head, either misquoted you to start with and needs the rates to move in their favor so that they can actually get the rate that they promised, and or there's something there. There's something, because rates have improved. If you've been in escrow for 30 days, the rates that you're seeing today are the best rates that you've seen in 30 days. Okay. So why would the lender say you need to wait? I don't understand that piece. It's like, if I were a lender, I would say, hey, listen, rates look to be improving. The data's kind of in your favor. If you're, somebody that is willing to take on the risk, then maybe we float it and we see what happens. But these are the best rates that we've seen. Now, maybe they quoted you a lower rate and that rate has just not happened yet. And that's what they need to happen in order to lock it. Can't say that to be true, but look at your loan estimate that you got. What rate were you told, when you originally came into it? Is the rate today better than that? If it is, you're already sitting in a better position. Don't get greedy.
And there's a subtle difference here in what we're talking about. We're going to advise you. I'm going to advise you. When Jeb used to do loans, he would advise you. I'm not going to tell you we need to do this or you should do this. So saying that rates have been dropping slightly, he knows this and is trying to help you. I don't know shit. I know what the chart is telling me. I know what the odds are going forward. We don't know what's going to happen tomorrow. No one knows this. So present you with the facts, advise you so you can make the best decision for you and your family.
All right. Ryan says, what will happen if the upper middle class, such as doctors and lawyers, can no longer buy homes in Southern California, Josh? So is that something that we're getting close to? Is that a problem? I mean, you see people with incomes all the time. Sometimes they make $200,000-$300,000 a year individually, sometimes combined, right? And they still have trouble buying a home. So what are your thoughts on that question?
It's just not reasonable. We can sit here and say, well, what if this terrible thing happened or that terrible thing happened? It's not going to happen. The cure for high prices is high prices. You've heard that said in a million times in a million different ways. Housing is unique in that you need land and you need regulations that allow properties to be built on there to keep prices intact. But you can drive through many, many areas in Southern California and you can realize no doctors or lawyers are going to live there, much less get priced out of there. So it's an unnecessary worry or fear.
Agreed. And again, wages continue to rise, and guess where they're rising the most? Healthcare, and self-employed borrowers that are able to set their own fees, attorneys in many cases. So, could it happen? Anything's possible, but the reality is it's probably not likely to happen. I mean, your median home price here in Southern California, where we're located, is about $1.2 or so million. Might they get priced out of the $4 to $5 million homes? Sure. Are they going to get priced out of homes entirely? No, they're not. It's just, you might not be able to get what you want per se, but I can't get what I want either. So,
to your point, that final point there, Jeb, when things were in the tank in 2009, 2010, there's an area over in Newport Beach that I wanted to move to, and you could find distressed properties, beat up, ugly houses. And One came on the market. Brian Johnson, a friend of mine, Jeb, that you know, a high-end realtor here in Orange County. He has a new listing come over. It's in Dover Shores. And I'm like, ooh, it's going to be awesome. And I look at it, and it's rich people that spend a ton of money with terrible taste, but highly, highly upgraded house in an awesome neighborhood. When I was looking at them, distressed properties were low millions, 995 to $1,050,000, $1,001,000. They wanted $8 million for this house, Jeb. I'm like, I don't know. I don't know what the world is coming to. But again, that is one small, very desirable market. Still plenty of places in Orange County where a person such as myself can afford. But there is the reality of some of these very exclusive pockets. People who make a lot of money are getting priced out of them.
Good stuff. I'm not sure what the name is here.
Just watch.
Says, what channel do you prefer to watch this on? Watch it on whichever channel you prefer. I know it is somewhat confusing having the same exact stream on two different channels. Watch it on whichever channel you want to watch it on. It's all the same thing. At the end of the day, you're getting educated. Doesn't matter where you watch it. But if you do watch it and you enjoy it, hit the like and subscribe button. That's the most important.
That's the important part.
Scott has a question. Says, as a first-time home buyer, well qualified, 20% down, but don't have the need to get into a house, just the want to get into one. Should I buy now or continue to wait? I'm not in any rush. So, Scott,
have you ever done a video on this topic, Jeff?
Many times, in fact. It's, if you are in that position, you don't feel rushed, you have time to wait. I don't think you're in a market to rush out and buy a home. At the same time, I don't know that housing is going to get any more affordable per se. You might see lower rates. Lower rates are going to be a little bit more buyer demand. You might see home prices stagnate a little bit in some markets out there. But really, it's about finding the right house at the right time in your life. If that's now, if that's 6 months from now, if it's a year from now, just do it when you can, when you're ready. There doesn't have to be a rush or a pressing need for it, but understand the sooner you do it, the sooner you can actually fix your housing costs. And, at some point, if rates get better in the future, you can refi. If rates get worse in the future, you've locked it in. It's this question is very hard to answer without knowing, everything. And quite frankly, it's not our decision. Like Josh said, we give you our thoughts. It's up to you to make the right decision. But I would say if you can find the right house, you're comfortable with the payment, you have a longer term time horizon, then that's when you should do it. Simple. Josh, how soon should you, or have we answered this question, I guess is a better question. How soon can and should you lock your interest rate during escrow? Did we do a video on this that hasn't been released yet?
Yes. Next Tuesday, we're going to do an entire podcast episode on rate locks, and it will cover this, but it is not available yet. So we will answer you right now. You can lock it as soon as you have a purchase agreement. And there are actually lenders who offer a lock and shop. So once you're approved and we know that you're going to get a conventional loan for $450,000, you can lock that and go and find a property within the next 60 days and have that interest rate be honored. Many of them will even have a float down option if rates improve during that time. But the reality is 99% of borrowers are going to lock sometime between getting an executed purchase agreement and getting their closing disclosure out. We cannot send a closing disclosure out. If you'll notice on your loan estimate on the top of page 1, it says whether you're locking or floating. That is not there on the closing disclosure. That closing disclosure has to go out to you at least 3 days prior to closing. So realistically, sometime 5 to 7 days prior to closing is your absolute last point to be able to lock. It goes back to what we talked about at the top of the show. What do we think is happening? What do we think comes next? And what your risk tolerance level is. We've seen some really nice improvement over the last 3 weeks. We have some cautious optimism as to why that may continue for me personally. And for most of my borrowers, I believe I got 6 or 8 borrowers right now that are all floating, but we're very cautiously floating. We're looking at it every day. Lots of texts in the morning. Hey, what happened with the morning news? Because most of it comes out at 5:30 Pacific, 8:30 Eastern. So it's what happened? Are we cool? What are you thinking? Does the chart look any different? Like, no, still looking good. Let's keep an eye on it. And let's continue the conversation tomorrow. So hopefully that answers it. As soon as you have a contract, you can lock. You have to do it about a week before closing. And it really comes down to what you think is going to happen and what your risk tolerance level is.
All right. Here's a good question from GD. Says, should I go with a local lender, higher interest rate, but better communication? Major lender has better rates, but lacks in communication. Is there any way I could negotiate with the local lender to match? Josh, if someone called you and was comparing rates, They liked you better, but your rate was slightly higher for whatever reason. Is there an opportunity for you to match the rate in some cases?
So absolutely. So if it's a realistic quote, if I look at it and go, that's legit, we can absolutely match it. We have to make a business decision and go, is there enough margin in there to make it worth our time? Most of the time there is, even if it's not the money I want to make on a loan. My thing is, once you've done a loan with us, you're not going to want to do it with anyone else. And so it's a free audition. So even if we don't make the money, it's a unit for my team. Processor makes money, loan officer assistant makes money. Maybe I don't make as much as I wanted, but got to add a client to our database that we're going to be in communication with going forward. The part of this question that's really interesting, if you're talking to one of the big national call center lenders, their terms suck. So if your local lender is even worse than what they're offering you, I'm just kind of blown away by that. You're probably looking at the wrong or with the wrong source. Now, if you like that local lender, we talk about this on the show. Don't just shop for interest rate. That's only 1/3 of the equation. Shop for knowledge and expertise, shop for communication. So your connection with this person and feeling like they communicate with you, they know you, they understand you, they're on the same page. So if you get that from that person, you may be willing to pay a little bit more. But if you're looking with a local broker, there's no major lender. We don't, other than say, Rocket, Loan Depot that have the big call center operations. Like there's not a big national major lender. Wells, Chase. I get excited when I hear someone says, "Oh, I'm shopping with these guys." They're cool. We're going to look awesome relative to that. Even the bigger regional players, mortgage banks that some people have heard of, but not everyone. They're not household names. Most times we're going to be a little bit better than that. So when we say go with someone that has knowledge and expertise in communication, you should be able to get the best of both worlds. You can't get the absolute rock bottom lowest rate because those are generally offered by call centers operating off super thin margins that are doing high volume, and they're not going to give you knowledge, expertise, and communication. But you should be able to get the best of both worlds. 9 out of 10 interest rate with 10 out of 10 on the two other equations. So check if you want a second opinion and you're somewhere in the states that we cover. We got 18 states that our team can help, 7 that I'm licensed in personally. Would love to talk to you and give you a second opinion on it.
Good stuff. And you can reach Josh and our team by using that referral link in the description of this video. And same thing on the same thing on the Riverside. Same thing on the real estate side. If you're in Southern California, need a real estate agent, I personally can help guide you through that process. If you're outside of that area, I can refer you to one of my trusted referral sources to guide you through that process. So use that referral link and reach out. This question, Josh, is similar to the one you just answered, and I'm just going to throw it up here just so I can say that. It just says, interviewing a few realtors before deciding who to use to buy a home, but how do you decide who to choose between lenders? Josh just answered that for you. So if you're just listening now, rewind about 2 minutes and listen to what Josh said about choosing your lender, but that should more or less get you the answer that you need. So Josh, there's a couple of questions here. We'll answer this in a moment, but we'll come here to Mitchell's question. It says, if you are the buyer and you want to talk directly to sellers and either let your agent know or not know, is this okay? I was just curious how that works. So as a buyer, you're not really in talks with the seller. Your agent is who you've hired to communicate essentially on your behalf with the agent on the other side, who the seller is hired to communicate on your behalf, on their behalf rather. So the agents are communicating on behalf of both parties. If you wanted to speak to the seller, if you wanted to present an offer to the seller, you can ask your agent to talk to the agent on the other side. What I'll tell you is 9 times out of 10, it's not going to happen. It's like having an attorney. Basically, your attorney telling you, I advise you to let me communicate on your behalf. That's essentially the same way it is here. So you're going to have a very difficult time actually having that conversation with the seller, unless you're already in escrow, unless you've already released contingencies, unless it's just about, hey, I want to know how the pool equipment works. Hey, I want to know how this works. If it's anything to do with the negotiation of the transaction, pretty much off limits in most cases. AB has a couple of questions here. Says, hey guys, hey guys, Jeb, how would a buyer represent themselves to try to avoid paying a buyer's agent commission? With this whole lawsuit and new rules, some buyers will try this. Just curious how. So a buyer is going to have the contracts. This is the most interesting part of the whole thing. Is a buyer is going to have a contract in order to represent themselves in order to buy a home. Because an agent like myself, I can't give you the contracts. I can't facilitate you buying a home. So you need your own representation to buy a home. If you say, I don't want representation, I want to represent myself, then you've got to be able to come up with the contracts in order to do that. But here's the best part is you submit one of those contracts over to me that isn't the California Association of Realtors contract. We're going to talk, the seller is going to talk, and we're going to talk about why that contract isn't one that we should use, because it doesn't protect the seller. It doesn't protect me as the agent, and probably doesn't even protect you, to be completely honest. So it's going to be an interesting scenario. It's going to be an interesting world when that happens, because you're going to have some buyers try to do it. And the reality is it's going to be very difficult, at least based on where we are at the moment. Now, there will be companies online that specialize in sending you a contract, specialize in selling these documents. But guess what? You still have to know how to fill them out. You still have to know what boxes to check, what not to check, what days to put in there, what not to put in there. You know, I saw an example yesterday of somebody talking about Chicago real estate, sells houses in Chicago, and a buyer submitted an offer to him, a purchase agreement to them. And the way real estate law works in Chicago is you've got 5 days to do your due diligence, your inspection on that property, at which point your contingency to do that inspection has passed. Your deposit based on that is already, you've released your deposit based on that time frame, something along those lines. And what happened was a buyer went into contract, represented themselves, and at day 7 they said, I want to get a home inspection. The guy's like, dude, that's already passed. It's like, why didn't you let me know? Because I don't represent you. I represent the seller. And it was like this whole conversation. And that's what you're going to have. You're going to have issues where people try to do things on their own and try to represent the agent because it's easy being an agent. And at the end of the day, it's going to end up costing them more money. And you don't know how to negotiate in most cases. So you might think you do, but when it comes to contracts and that sort of thing and timelines, it's a whole different world. So proceed with caution is what I would say. Josh RR has been told a day or two before closing, I can get a lower rate. Is that true? Might be true. But could you actually follow through? Could you actually take advantage of it? I guess is the better question.
So you can't wait until a day or two before closing, because we talked about the timing of the closing disclosure. Closing disclosure has to go out 3 days before you can sign your loan docs. In many states like California, it's dry funding state. So you're going to sign your loan docs 1, 2, 3, 4 days before closing. So realistically, about a week before closing, that closing disclosure has to be signed and the loan has to be locked at that point in time. There is nothing magical about a day or two before closing. The market fluctuates on a day-to-day basis. A day or two before closing, it could be much higher. It could be lower, but you have to decide when to lock that rate anytime between, again, getting a contract and getting your closing disclosure out. You can lock at any point. Waiting doesn't make it necessarily get lower. It could actually make it get worse.
Mitchell said he wished he would have found us 4 months ago. He said he did everything backwards. So here's the thing. We've been on YouTube. I mean, I've had my live for better part of 3 years. Josh has been on here consistently for at least 18 months, probably 2 years at this point. So we've been around, Mitchell. Where have you been? Like, we've been here. What have you been searching on the interwebs? We've gone nowhere. In fact, we've got less people watching us now than we did a couple years ago. Smart Fox says, on Prop 19, can I buy a house before I sell my primary house within 2 years? I believe with Prop 19, you can now do that. You can.
Jim, I pulled up, I saw this, so I pulled up the fact sheet before you part of the question. It says to qualify, replacement resident must be purchased or newly constructed within 2 years of the sale of the original property. So they're wanting to know, can you buy and then sell it 2 years later? It says residents must be purchased within 2 years. I don't see anything about the other side. It says either one or both the sale of the original property or the purchase completion of new construction, the replacement must occur on or after April 2021.
I believe, again, don't hold me to this, but I believe you can now buy the property, the up leg, and then sell the house within 2 years and then transfer the tax basis within that period. Don't hold me to that. But if you want to email me directly, I'll find that answer out for you specifically. I'll need a reminder. So email me. My email's in the description of the video, I believe. It's somewhere. You can just search my name. You'll find it pretty easily. And I'll actually get you the correct answer on it. I'll reach out to somebody and confirm what I believe to be true and or invalidate myself. Josh, we've been on 58 minutes. Hopefully everybody watching has hit the thumbs up, has subscribed to my channel here. If you're watching on the Educated Homebuyer, which 38 of you are, hopefully you're subscribed over there. We only needed 23 people to hit 4,000 subs on that channel. So help us grow, help us educate more people, help us, become, a staple with people looking to buy homes and just get educated.
So that people like Mitchell don't say, where were you 4 months ago when I bought a house? We need all of you to like and subscribe so that the algorithm knows Mitchell and people like him need us before they buy a house.
Well, be like Peak Shots. Just want to drop by and say thanks for all the great content. It's helped me and my family tremendously. We appreciate that. That's all we're looking for out of this, guys. We would love to interact with you. Quite frankly, if you're looking to buy, sell, real estate, Josh can do your loan. I can help you buy and sell real estate. Josh is fortunate enough to be able to help you pretty much nationwide to some degree. I can only really help you in Southern California. Now I can guide you, but I can't really help you in other states. But reach out and let us be part of the scenario. Let us be part of the you getting to the finish line. That's what
Jeb is being moderately too modest. So realtors are only licensed in a state. They're only experts in a geo-local area. We on the loan side are able to benefit nationally, but Jeb has an amazing network of pros. I have been in 15, 20 transactions with realtors that he has referred on the other side. So if you don't have someone, I can vouch for the quality of his network. They all come from the same place. They've had a lot of the same training. They treat clients the same way. They handle transactions the same way. And much like the mortgage side, they're not all created equal. 80% of realtors, 80% of mortgage people are worthless. Of the other 20%, the top 20%, so the top 4 to 5%, it is a night and day difference having them handle your mortgage, having them handle your real estate transaction. So if you don't have someone, we definitely have a shortcut for getting to someone like that.
All right, Josh, I'm going to ask you a question that's not on the screen here because someone emailed me and they actually emailed both of us because it came in through the Educated Homebuyer email. So I'm going to read it online here and you can answer whether or not you can actually help. So basically says they watch the YouTube channel, supposed to close escrow by May 24th. That's 9 days from today, Josh. Their lender keeps messing things up on their loan. They ask, can you help getting a loan before closing? They're asking, can you help, Josh? They have their insurance. They've done their appraisal. They've done inspections, everything. They just need to close. They gave you address. They're here in California, a name. So Josh, can you get a loan done in 9 days?
The fastest by law that you can do it. There's waiting periods to get your loan estimate out. You have to wait then to when you can sign the closing disclosures. We said it has to be 3 days before consummation. 8 days is as fast as it can be done. I think the fastest I've done one in the last year is probably 12 days. 10 to 12 days is hauling. You're doing it really quickly. So a well-qualified borrower, 10 to 12 days, very, very doable. Someone that has all their stuff together, sends it over tonight. We set it all up in the morning, get that loan estimate out, either get the appraisal transferred over or rapidly order another appraisal if the other lender's being difficult on transferring the appraisal. So you probably would need a couple days extension, but we could make every effort to get it done. We can go to one of our preferred investors and let them know, hey, I need a 24-hour underwrite so that we get the conditions back, everything all lined up. So is it doable? It's doable, but you're getting the very short end of not being able to do it.
And here's the thing is part of Josh's job is to communicate with the agents and let them know, hey, this is what's happening. We're in the game now. It's going to be fine. We might just need an extra day. I want to communicate it now so that we're not doing it on the day of. People appreciate that and will typically allow you to do it. So here's what I'll say. I'll speak on Josh's behalf and say he'll contact you via email after the show because I don't see a phone number in there. So if you want to email, if you're watching, I don't know if you're watching this or not, or if you just whatever, but if you are watching, just come back with a phone number and Josh can contact you. So we've been on here an hour and 3 minutes. No additional questions have come in since then. So what we're going to do is we're going to wrap it up for tonight. But Josh, you and I will be on here either tomorrow at some point or Friday at some point, maybe both days, to do another hour, or not another hour, to do up to an hour of content. I know a lot of people said, hey, I couldn't make the live, but I just watched it afterward. Awesome. We'll do it. If nobody shows up, Josh and I will still have a conversation. How's that? We'll talk to each other. We'll provide value and what we feel like you guys want to know. That's what it is.
Might crack an 805, maybe a high noon. Just sit back,
who knows?
Shoot the breeze.
Exactly. But we do appreciate you showing up every week. We appreciate the support. If we can be of assistance to you, we want to be of assistance to you. Reach out, give us an opportunity to help. We're doing so by educating. Let us get you to the finish line. Like and subscribe. Until then, buy right, borrow smart, build wealth. Josh, adios.
Amigos.